Good morning, everybody. Just prior to 6 a.m. on Thursday, August 17th, one day ahead of OPEC's Friday, options expiration Friday tomorrow, the third Friday of every single month. And if you haven't learned already, if you are fresh to trading, this week is designed to absolutely churn, burn, and destroy small retail traders. Yes, you can get ahead of the trend. Yes, you can get some very good trades. 99% of traders get completely fucked during this week. Into the data, 4 gap downs in a row. Boom, boom, boom. Not having any sell-offs. We are now 101 trading sessions since our last 100-point range trading session back in March. I'll get to that in a minute. 14 trading sessions now. We are into this dip. We're only 181 points for the month of August. August is far from over. Far from over. And this dip is now from the highs placed over there in July 27th, when all of you who were with us remember getting a plethora of puts trades for August 25 next week. Anyone still in those? I still see more downside, although because we are so deep in the money, feel free to take the money off the table. There's going to be another puts trade coming very, very, very soon. And it is going to be an epic one. So, 46-point range yesterday, 46-point range on Tuesday, 36-point range on Monday. We are slowly churning this dip. And I'm going to go over this dip here real quick because using a quote from one of the people I respected the most in my early trading years, Mark Haynes.
However, I'm going to step out on a limb here.
This is the big, hold on, everyone. We've been waiting for this.
I think we're at the bottom. I really do.
Yes, I do. I do believe for this dip that we are in currently, the bottom is in. We made perfect contact with what was my primary focus for those August 25 QQQ 380 puts, and that is the 23.6 retracement from the highs to the lows. It depends how you draw it, to the March lows. We made contact with it yesterday. I like that. SPY here. Yes. Right here, same thing. 440.89 yesterday, prior to the FOMC minutes, when, again, you're following in the chat room early in the morning, I made that trade on the SPX calls, 130% in like 12 minutes. Yesterday, again, following over there in the alert room, and everybody getting ready for the FOMC. What was it? You had the minutes; those worked. And here, 121, 225s, and sell order at 5. 20 minutes later, 25 minutes later, I was out half of it at 6 and wanted to ride the rest to 10. Didn't work out because we rejected right at the 50-day moving average. But again, sticking to the point, the 23.6 retracement to the March lows accomplished yesterday into the close, again with Mark Haynes.
However, I'm going to step out on a limb here.
This is the big, hold on, everyone. We've been waiting for this.
I think we're at the bottom. I really do.
And in speaking with that, again, sticking with our big wide ES that we have been tracking, we are going to get this gap filled. Please understand, this gap from way back in June when they rolled over options it's going to get filled. It's going to get filled. So I'll bring it out here onto what we're looking at. And again, this is what we were tracking from when we initially got our first move down back in July. The 161 was our target. The 161 kind of worked. Came right down to visit it, came right down for a little bit of a breach. This was our big day a week ago, as you remember, CPI. and we fell right back into the support channel. We came down to the 200 extension. Perfect visit. Looked to break out of that channel at the beginning of this week, and we failed it. And here we are with the throwdown. Throwdown being throwing ourselves out of the channel. And where do we go to? Right to the 261.8 extension. And here we are now at that same Fibonacci that you have on your SPX for 44, 34, 35. It's right here, 443670 on the ES. That is now the point to break. Break above that, and we can start to assume that we are going to be able to get a move to that 50-day moving average. So SPX here, same thing. Bam, bam, bam. 44, 34, 35 right there. Bring into yesterday, and yesterday cleanest video game that you could ever want to see. Right to the 50-day moving average, rejected. Again, rejected. Again, rejected. Down to that 44.34, rejected. No, we're not going to reject. And we threw down. As we came back up to the minutes, prior to the minutes, rejected, a little bit lower, right back down again. Threw it for the minutes reaction, which is where we took that second trade, and then you just said, fuck this is over. But I'll bring you into this, okay? This is over because of what you're getting over here with the Japanese yen. All right. Here's your Japanese yen on its breakout. And this is not good. Not good. Not good for the market. Not good in any way, shape, or form. Here are your October highs. As you remember, back in October, the S&P bottomed. We're coming up to the 1998 level here, 147.65. All right. This is, again, a scene of the crime where it is not a good scenario for the markets, because as you have this taking place, what you have is a hell of a lot more activity over on the bond market rather than what you should be having in the stock market. So money's coming out of the stock market, going into the bond market because of this big inverted head and shoulders, which is going to be looking for the 10-year to break that 43.33, same place, same date as that Japanese yen spike, and try and test that 44.10. You get a move up here into this range, you're getting a incredible move to the downside over on your SPX and your QQQ, which is what we've been looking at. We are still focused, okay? Still on that move down to 43.55, 42.55. That's still what we're looking for our downside over here on our wave 4. This will in no way at all negate any bullish presence for them to finish this off and then make the move back to the upside. Absolutely not, because I'm tracking what I'm looking at as this being a 1, 2, 3. This would be our 4, and then 5 would be the move to the upside, which could take months to complete. So from a short-term point of view, I do believe the bottom is in. Now, a little bit of support onto that. Here we are seeing the VIX at 1706. You can't pick that number any better. The February 2023 lows. Right up on that 18 when we started to get that dip. This was August the 8th, and here we are with a, call it what you want, bear flag set up above 1622. A big, here's your 1710 again. All right, over here, 1708 on July 6th. This is a big trap from my point of view. And now everybody will start to get short, whereas we're looking to get ourselves a bounce. And on that bounce, bringing us into something a lot more realistic with SPY, we're now looking at 443. 443.75, where the 50-day moving average is crystal clear resistance. This and the 5-day moving average are going to be sandwiched on top of each other right around 444 today. They're going to be right on top of each other. The 50-day moving average is moving up. The 5-day moving average is moving down. Big gap from earlier in the week, unfilled. And your 50 retracement now from this entire move is going to be over here right around 445.37. Correct? Incorrect. 449, 449.28, or call it your highs over here from Thursday, not your CPI highs. Your highs from Thursday is now your 50 retracement and our upside target as we're going into next week when the big trade comes. We've got NVIDIA, we've got Jackson Hole, we've got the full moon coming. Only, again, only have 181 points for the month of August. Let the bitch bounce. Let the bitch fucking bounce. Sit back like Ted Williams. Let them throw you balls. Let them throw at your head. If they're not throwing the ball that you can hit out of the park, don't swing at it.
Hi, I'm Jose Canseco, and I want to talk to you. So call 1-900-234-JOSE. I'll give you the latest scoop on baseball and my personal life. If you want to know if I use steroids, how fast I drive, or about why I was carrying that gun, call 1-900-234-JOSE.